Yeah, hi everyone. This is Finance Meets Real Estate. We have Jerome Myers here today. Jerome is going to talk about why he left single family investing behind, and you should too. So he's the founder and head coach of Myers Methods, and so he will discuss why he started speaking and having speaking engagements in general, and is giving this talk specifically. You talk about the difference between single families and apartment buildings, roadblocks to getting in, a case study, his big mistakes, etc. So Jerome is, so he was previously worked in corporate America, where he realized his goal, offered financial gain but little significance. He's the founder and head coach of Myers Methods and has been featured in Black Enterprise, Business Insider, and numerous podcasts. Yeah, without going into too much information, it's really a pleasure to have you here, Jerome, today. So I'm gonna pass it on to you, and if you guys have any questions, we're gonna do a Q&A at the end. If you have, where we will open up the floor, if you want to ask questions before that, you can feel free to put them on the chat as well.
Oh man. So is that it? Is it my turn to go? Is this how this is going to go down, huh?
Yep.
Thank you so much for having me, man, and grateful for all the folks who are joining. I like picking with Angel because she usually has a halo and she's here. So I don't know how many meetups she goes to in a week, but I think it's like every night, 2 times sometimes. So Angel, I'm so grateful you're here. And you're actually the only name that I'm familiar with in the group. So people are joining pretty rapidly. My goal whenever I present is that there be more people on when I finish than when I get started, because for me, that means I was actually interested in informative or educating. I don't even know if that's a word. So for the people that are here, since everybody has their cameras turned off except for Angel, let me know where you are. If you bought a deal, give me a 1. If you have invested passively, give me a 2. And if you're a deal lead, give me a 3. 1, if you haven't bought a deal. 2, if you're investing passively in syndication. And 3, if you're an active operator. Hey, Tamika, what are you doing here? This is awesome. Okay. All right. So 1s, 2s, and 3s. It looks like the 1s have it. Give me some more 1s. Come on. 1, 1, 1, 1, 1. I love 1s. Oh, what are you buying? Okay. So there's a couple of folks here. So I actually do this to set people up. So everybody who's a 1, you want to talk to everybody who's a 3, right? And then after you make relationships with the 3s, you want to make relationships with the 2s because they've got money to invest in deals, right? So if you want to be an operator, you want to buy your own deal, you need to partner with people who have experience, and then you want to bring in people who have capital. And I'll talk a little bit more about that. And so I actually have the ability to share my screen. So I'm going to jump into a PowerPoint. And if you have questions, go ahead and drop them in the chat as I go along. We are going to go through, I don't know, like 30 slides. It won't be much more than 30 minutes or so. But the goal here is to serve you. So if there is a question about something I say, a lot of stuff I say is pretty controversial because it's not what most people are pitching. Please drop it in so that we can do what we need to do. So is everybody seeing the big presentation? Why I left? Or are you seeing the backside of my stuff?
It looks good, Jerome.
Looks great. So you see my mom and dad. Is that right? Like my mom and dad are up there smiling at y'all. They're so proud of me and they have no idea what I do. Like they have no idea what we actually do. And so I pulled up one day, and this was probably 18 months into my multifamily career, and they were like, hey, why does this building have Myers on it? I was like, because we own it. And they were like, what? Like, which one do you own? It's like, no, the whole thing. And this thing is S-shaped. It's 20 units. And they were like, what do you mean? I was like, we buy apartments. That's how I make money now. And they just kind of looked at me a little confused, but yeah, they are excited. Most people don't know that you can actually do this. And those who do don't actually, what I consider, get tuna in the boat. they go off and they go Moby Dick hunting, right? They want to buy the biggest thing they can actually buy because they want the big acquisition fee and they get rich in one deal. And we take a very different approach. But before we get into that, let's go through the agenda, right? So I'm going to go through why I started speaking, and I give this talk specifically, the difference between single family homes and apartments, and the investment strategies that go along with those, the roadblocks to getting into multifamily. We're going to use me as a case study, and you're going to learn about my biggest mistakes, because I feel like that's the fastest way for people to learn, is to learn from somebody else's mistakes. I'm offering some free resources. We'll dive into Q&A, and then we'll do a wrap up, and I'll let you know about the Mid-Atlantic Multifamily Investing Conference that is coming up September 17th through the 19th, and love to have you guys join us there and get a deeper dive on multifamily investing. It is virtual, so you don't have to book a plane ticket. I know it's still kind of wonky on whether people are traveling or not. So we're going to take our time. And so, I'm super grateful for this opportunity, because I like sharing the front half of this, and then it'll put everything else in the backside. And so before May of 2019, I was completely invisible. I didn't have any online photos except for a photo when I was in college, right after we lost a football game, and I'm sitting on a knee holding my face. I probably was crying, and I was like, yeah, I don't want any more pictures on the internet. My social media presence wasn't very good. So I had a logo as the little circle picture on all the different platforms, and I thought that I was just going to be able to build a brand like Coke or Pepsi or some of these other Fortune 500 companies who've been around for a really long time and have brand recognition. And I was so poorly mistaken. But, I was doing the best that I could because I wanted to be a big business, right? And so being a ghost was a problem. It was an absolute problem. And what I realized, I was part of a bigger problem. You might recognize some of these folks. They get a lot of traction on the multifamily talk circuits. They speak at conferences. They have meetups. They organize other opportunities. And I was like, man, nobody up there looks like me. And I just thought it was so weird. And then I was like, wait, there's no ladies. And I've got 2 little girls. Like, what's going on here? What's up with that? And so, I hadn't told my story, right? I was operating in my little own world. My last job in corporate America, I got the fortune of building a $20 million division for a Fortune 550. And while I was doing that, I was lending money privately to fix and flippers in single family markets. And that was where I learned about rehabbing. And then in 2016, I decided I was going to drop out of corporate America and pursue real estate full time. I went into the School of Hard Knocks. I enrolled in YouTube University because you can learn anything with a video from YouTube. And I started listening to podcasts about 40 hours a week. And eventually I found my first deal. But there was a catch, right? I got turned away from 10 banks. I went to them and said, hey, I got a deal. Don't you want to lend me $1 million? They said, no, not at all. Right. And so I kept educating, but eventually I realized that nobody was going to give me the money. So I decided to start fixing and flipping, since I had that previous experience as a private money lender. While going through those flips, I was fortunate enough to meet some partners, and I was able to get into my first multifamily deal. And I was even elevated to the role of asset manager. And that was so cool, because what happened was my name ended up in the paper. And while my name was in the paper, brokers were reaching out, loan brokers, and they wanted to know, hey, were we going to refinance the deal? And if so, when? And had we already picked a partner? They wanted to know what else we had in the pipeline. And, the same folks who told me no, they didn't want to lend to me, also wanted to take me out to lunch so I could learn more about their products. And so things were starting to happen for me. After we got through a few deals, my friend, coach, confidant, James Bryan said, hey, we're using a Myers methods to do these. We've got a repeatable process. And so we started talking about our approach to multifamily investing. At that point, we'd raised a little over $1 million through our different partnerships. We'd gone through a few repositions. And, kind of the icing on the cake was we started going down this path of 120 unit development here in Greensboro, North Carolina. and really excited about the progress that we're making there. But I wasn't telling anybody about any of this, right? I was just sitting over here working away, meeting the people that I thought I needed to meet, but I wasn't showing anybody else they could do it. And by doing that, I realized that I was part of the bigger problem. See, I believe that diversity matters. I believe that all of these people look like multifamily investors. It doesn't matter what your background is. This is for everybody. And I think it's important for meetup organizers, podcast hosts, conference organizers to create a platform and opportunity that actually shows the diversity that exists in multifamily investing. And so, what I encourage people to do, right? You guys are on with me today. If you see people running conferences, specifically conferences, because that is monetizable, and they don't have anybody who looks like you on their stage, don't buy a ticket from them. And go find a conference organizer who does have people on their stage who represent you and the people that you know. Because until there is a connection between the money and the speakers, nothing's going to change. And I thought we could just get through that by talking, but that's not realistic. It's not actually happening. And I got a really crude reminder a couple of weeks ago that people aren't going to actually make an adjustment until the consumer says or demands that they do. So what does this have to do with multifamily investing? Well, one thing, and this is probably the biggest thing, I think that educators have confused us. I think that if you don't know what this is a Cashflow Quadrant. It's a Robert Kiyosaki concept that he brought up in Rich Dad, Poor Dad. And I think he wrote a book on just this topic. But most folks are employees, right? And they want to be, and they're rushing down here to be investors. And that's not how you get rich. You get rich through equity as a business owner. And so what I really want folks to know, if you don't take anything else away from this, if you drop early, is you want to take your paycheck, if you're an employee, invest it in a business, make that business work better, create equity, harvest that equity, and then invest that equity. When you try to go from here to here, you spend a very, very, very long time working as an employee because you don't have the equity gains of being in a business. And I think this is the shortcut that most people don't talk about. And why don't most educators talk about it? Because they just need passive investors for their deal. The equity gain that you get as a passive investor is going to be much less than as a business owner. And that is the accelerant that you need in order to get free. Now, if you plan to work out for the full 40 years or whatever you've decided is your retirement age, great for you. But if you want access to your capital sooner rather than later, then I think this approach actually makes a ton of sense. So when I talk about retirement, what am I saying? Right? Pension plans, 401ks, and taking Social Security. What I found is that the average American household has about $84,000 saved in retirement. For most people, that's not even a year's salary. So we've got to figure out another way in order to get this thing to work. And so one of the things that I've heard, and hopefully the chat still works and we've got some more people joining, so that's amazing, is that all you got to do is buy 10 homes free and clear. So buy a house a year. And if you buy a house a year, then you will absolutely be able to enjoy your retirement. Has anybody heard that before? Or is anybody going down that path as a strategy? Give me a 1 if you've heard the strategy of buying a house free and clear for a year, and that'll get you free. Give me a 2 if you're saying, yeah, I never heard that. You are absolutely crazy. We're not going to do that. I got a couple of 1s. I guess I'll take that today. All right. So in this particular instance, the person believes that they're going to make $9,000 in gross income. They're going to take 10% out as a property management fee. They're going to have $450 or 5% in maintenance and $710 in taxes, $650 in insurance. So their net income is $6,290. So, if you got 10 homes free and clear, you're making $63,000 a year. That's a whole lot better than the $82,000 that people had saved up. Now, in concept, this looks like it's a great idea and it'll work. We'll come back to that later. So let's talk about the reasons why I say we should leave single family homes behind. One, right? Scattered site. There's a lot of headache that comes in managing properties that are all over the place. People say, oh, well, it needs to be diversified. And I don't want to just be in one neighborhood because who knows what could go wrong. But what if you're really good at it? Like, what if you were right? What if you can buy quality real estate in a great area, take good care of it, and grow? I think that makes a lot of sense. But you're not going to get that in single family because it's very rare that you're able to buy houses that are on contiguous lots or right beside each other on the same street. The valuation model for single family homes is really vulnerable. What are you saying, Jerome? All right. So if a house beside me sells at a really low price and then I get ready to sell mine, that comp is going to show up for my house when I get ready to get it appraised when I sell it. And so what's happening is based on the other sales, you can get pulled down, or what a lot of people only like to talk about is getting pulled up or getting some appreciation. I don't like this about single family homes because it's dependent on what the other person decided to do. And they could have had financial trouble. Maybe they needed to move quickly. There's a number of reasons why somebody would sell their property at a discount. And I don't want my real estate tied to another person's situation. The principal pay down is barely happening, right? Most people are trading their homes or their properties in less than 5 years. So they're not actually getting a meaningful drop in the principal balance on their mortgage. Vendor pricing, when they come to service your home when something goes wrong, yes, there are things that go wrong when you have rental properties, is going to vary pretty dramatically. And honestly, with single family homes, those folks are going to charge a little bit more. So you want to be really careful about that piece because like we saw on the previous slide, this person only allocated $450 for the year for things to go wrong with their property. Scaling is extremely challenging. You know, I talked about that 20 unit building that we purchased. We did that in one transaction. Imagine having to do that 20 times in order to get the properties in your name. It's pretty intense. And oh yeah, you had to buy 20 properties that actually made financial sense. So keep that in the back of your mind as you're going through this. I think the thing that probably frustrates me the most, because I think it's the biggest opportunity or for risk, is people over leveraging, right? So when I say over leverage, some folks, because they can get a residential loan at something less than conventional, right? They'll go FHA and get a 97% loan. And there's no money left for them to make a profit because they have no money invested from an equity standpoint. And so then maybe something happens in the market, the value of the property drops. Now the person's trapped with the property. And the last thing I'll say is the price per door to rent ratio. So you take your rent number, you divide it by the price per door, or, you know, the cost of the house in this case. You get that ratio, and that number is going to be way out of proportion when you compare it to a multifamily property. Why does that matter? Well, that's going to be a really good indicator of how much money you're going to be able to make on a property. And so the higher that number, the better off you are. The lower that number, the worse off you are. And sometimes you may hear people talk about the 1% rule. And so they'll take the rent, the monthly rent, divided by the price of the unit. And if it's greater than 1%, it's a deal worth pursuing. If it's less than 1%, then they will say, I can't make money here. We're going to move on to the next deal. All right. So from my perspective, the traditional approach isn't working for most. Most people who do single family rentals are losing money. They don't know it. Most people don't think that you can buy something bigger than a house. And a lot of people think just because something's cheap, it equals a deal, right? I can buy a house in Ohio for $30,000. I should absolutely do that, right? Because rents or whatever. That's not actually true, right? And so there's a whole lot more mechanics that go into this. And so I want to kind of dispel some of these things and see if I can help people go along on the journey. So what if there was an alternative to both? The traditional savings with the 401ks and the IRAs, and buying 10 houses free and clear so that you can live the life that you've always desired. My thought, my thesis is, what if you could buy a business with real estate tied to it so that you can get it up to, 70, 80% leverage on it, right? You could operate that business. You can approve the operations of that business. Use that real estate as a collateral to get financing. And then because you improve the operations, get rewarded for your contribution, right? That's what I think would be pretty magical. And so that's why I think multifamily is a perfect place to go. And I think we should be doing it now. I think you can get equity through leverage, right? Because you're able to control all of the equity in a multifamily deal with a very small amount of money invested, relatively speaking. The assets appreciate as long as you operate them well and don't overpay on your purchase. I think they throw a lot more cash flow than you'll ever get from a single family home. If the deal goes as planned, you're going to have pretty high cash on cash returns, relatively speaking, to other risk adjusted assets. Millennials are placing a really strong demand on rental housing, and most of them don't actually want to take care of a yard. So where are they going? They're going to apartment buildings. And this is a space that we play in. And so I wanted to lay it out here, or at least note it. There's an increase for demand for workforce housing. What's workforce housing? Nurses, police officers, firefighters, those retail workers, those folks who are never going to get wealthy from their career. They typically have a pension on the backside, but they make our world go round. And so those are the folks that we like to serve. We really believe that they do great work and they should have an amazing place to come home and rest their head. So I think there's 4 challenges in getting into multifamily because, right, I just told you this is the way to go, but I'm not going to romanticize it and pretend like it's perfect. And I think the first thing that most people have to overcome is knowledge. Second thing is deal flow, followed by experience and then capital. Why is capital at the bottom of the list, Jerome? I'm going to buy something. I need money to buy it. Not so much, right? So in our model, we believe that first you get knowledge. From the knowledge, right? Because you want to have a baseline and not YouTube University. What I did was absolutely wrong. And we'll talk about that a little bit more. But you want a baseline. You want a base body of knowledge so that you can actually tell the difference between a lead and a deal, right? A lead is something that you spend money on and you're guaranteed to lose the entire time that you own it. A deal is something where you are set up for success and you can actually make money. And so if you don't have the knowledge, you can't tell the difference between a lead and a deal. The most frustrating thing that I get from new folks who are trying to get into the space is them forwarding me something that a broker sent them with no additional explanation. Hey, I saw this. Okay. You saw it. I know just off the cuff that the broker's working for the seller and their goal is to get as much as they possibly can from the seller or for the seller because that increases their commission. So it's highly unlikely that what they sent me actually is anywhere close to making sense in the model that we buy in. So that isn't helping me. And oftentimes there is this desire for them to be helped by me to figure out whether it's a lead or deal. But that's my expectation for them. I expect them to have the knowledge in order to be able to decide whether or not this property makes sense. And I'm not alone in that. The majority of the folks that I spend time with don't want to be sent a deal from a broker that's been distributed to hundreds or thousands of people because we're just not going to be able to compete on them because our buy box is a lot smaller than those folks who have less experience from an operating standpoint. So once you actually have a deal, and this was the piece that I was missing, you need somebody with experience to come in with you on the deal. If you've never done one, and this is what the bank showed me, hey, you don't have the right experience. And I was like, what do you mean? Like I just built a $20 million division for a Fortune 550. I have an engineering license. I've got all the other certifications, the MBA, engineering. I got all this stuff. What are you talking about? And he said, yeah, no, you've never actually executed this business plan. on a similar size property. And it was crushing for me because I thought I had all of the things that I needed in order to be a viable buyer, but that wasn't true from their perspective. And I'm so grateful that they did that, because had I gotten into that project by myself, I would have went bankrupt because I made a bunch of mistakes on the front end. So you take that experienced partner with your deal, and those two together are the magic that bring capital in, right? An experienced operator, the deal, capital is going to follow it because they're looking for a safe bet. And everybody really focuses on the somewhere between 40 and 20% that folks are bringing as a down payment, the equity raise. But your biggest partner in a deal is the bank. The bank, or Fannie or Freddie or whoever you're getting your loan from, the debt is going to be the biggest partner in the deal. And they're only coming in with proven operators and a deal that actually makes financial sense. So let's dive into the single family and multifamily thing and do kind of some side-by-side comparisons about the advantages and the disadvantages, or the cons, associated with each strategy. So from a single family perspective, they're more affordable, right? From a dollar amount. Appreciation is higher. Better tenants, some say. It's easier to sell them, so they're more liquid. There's rarely tenant-to-tenant conflict. And I'll never forget doing this presentation for RIA and having someone raise their hand and say, that's not true. I just had somebody call to tattletale on their neighbor because they were bickering back and forth about something that was in their yard or something. The cons with single family homes: difficult to scale, more expensive to manage, scattered sites, the valuation is market dependent, and vacancy. There's no resolution in the vacancy. If you have a single family home and you're treating it as a true single family home rental, if somebody moves out, guess who gets to pay the mortgage? Be the owner. Guess who gets to pay for anything that's broken? It's the owner. And for me, that 0% occupancy or 100% occupancy is probably one of the biggest deterrents. I had a couple of single family home rentals and I had some vacancy. And that was extremely frustrating for me, to be writing a mortgage check for something that I owned that was not income producing. All right. So multifamily properties, higher monthly cash flow, right? There are more units, more dollars are coming in, and the more dollars are coming in, the more you can take on from an expense standpoint. More granularity on the vacancy. We talked about 0 and 1. Now let's just take that up to a little 10 unit. You now have the opportunity to be 100% occupied, 90, 80, 70, 60, on down to 0%. Most of the times when people buy property, the property can take care of itself down to probably 70 or 75% occupied. And so that really allows 2 to 3 people to not be in their units paying before you get into a problem where you actually have to scratch out a check in order to cover whatever the expenses are from owning the property. And that for me is really exciting. Now, if you take that 10 and make it 100, now you're talking about 20 to 30 folks. And if you're staying in a state where, you're that vacant, there may be some issues with the property or the property manager, but it gives you that cushion. It gives you that safety factor. You're able to scale faster. It's always amazing when I hear folks who talk about they have 3,000 and 10,000 doors when I go to and listen to some of these multifamily presentations. And it's like, man, how in the world do you actually own that much? What I find out is a lot of people are just counting their syndication doors. But whether you're syndicating hundreds or thousands of units, or you're joint venturing and doing tens or 20s or hundreds of units, you can grow your portfolio in concept. You'll be able to scale your income a lot more quickly if you are doing these deals versus trying to buy a single family home at a time. You have the opportunity in multifamily to also control the value, right? So we talked about somebody selling their house for some reason under some duress in single family, and that adversely impacting your valuation on your home. Well, With multifamily, you're able to go in and improve the operations. And the thing that's going to drive your valuation more than anything is going to be your net operating income. And net operating income is the difference between your collected rent minus your expenses, right? Your collected rent minus your expenses gives your net operating income. The more that you can grow that, the more you can make your property worth. So that is where things get really interesting, because you can own a building on the same street as somebody else. And if you're a better operator, maybe you're charging more for rent, maybe you're better on your expenses because you're using a handyman instead of a licensed professional to maybe change your toilet flapper or change an outlet or whatever you want to talk about. That allows you to get more compensation whenever it's time for you to exit or refi your deal. You got the benefits of economies of scale, right? So we talked about a vendor coming over to the property where it's a single family home. They realize that it's one and done. They're not going to have some repeat or recurring business with you. So they're going to charge you a different fee than, that concept that, hey, there's 20 HVAC units here. If I cut them a deal and do a unit for $3,800 this time, they'll probably call me back the next time something comes up versus charging somebody in a single family home $4,500 or $5,000 for the same unit. When you get into these commercial loans, a lot of folks will tell you it's easier to do them, especially if it's non-recourse, than what you would do if you were buying a residential property and using a residential loan. And then there's the power of the cap rate. And the best way I can describe this is if you think about making $10 of net operating income and you have a cap rate of, let's call it a 10 cap, then when you divide that 10 cap into that $10 of net operating income, that equates to $100 of value on your property. And so when you start talking about pennies and dollars make a big difference, you add enough of those pennies and dollars up, and you can create a vast amount of income or valuation or value for your property by operating it extremely well. And so now let's jump over to the cons. And I actually consider the first one an advantage, but for some people, they absolutely see it as a con when they're coming in. Entry costs, right? And so what one of my friends from high school told me is, hey, man, you want to build a moat around your business. You don't want everybody to be able to come in and participate. And so by buying something that costs more, it eliminates the number of people who can actually participate in the game. And so these entry costs, right, because you're going to spend hundreds of thousands or several millions of dollars to buy these properties, it keeps a lot of other people from playing the game. That for me is really exciting. But for other people, they'll see it as an impediment because there's like, well, how am I going to get access to people with that net worth and liquidity necessary in order to get the loan in order to do that? And that goes back to talking to those people who are threes if you're a one or a two, right? So make sure you save the chat so you can reach out to these folks later on. The other thing, and I do actually see this as a con, because if you want to get your cash back out, it's going to be pretty difficult to do so, is the longer sales cycle. And that is because these things take time because of the due diligence necessary, right? If you're buying a 20 unit building, it's like doing due diligence on 20 single family homes from a physical inspection standpoint. You got to go in every unit. You got to shake every toilet. You got to check for leaks in every sink and so on and so on and so on. And so that stuff takes time. You also have some real financials. And so being able to comb through those and make sure that they're accurate and have a really good understanding of what your business plan is going to be in order to create that net operating income is essential. It's so important. I've heard so many stories on my podcast, Multifamily Missteps, where people try to cut corners, and what they realize on the back end is when they cut that corner, they created an issue for themselves. All right. So let's go back to this case study. All right. So I ask you to pull your calculator out if you got one on your phone or whatever, or you can do it on your computer, or if you want to do it longhand, God bless you, because I can't do these numbers longhand anymore. But let's talk about the maintenance number. That's the first place I want to go, right? That maintenance number is 450. I think they're wrong. I don't think it's actually 450. But if it was 6290 and their purchase price was 40,000, the cap rate on this deal would be 15.7%. That would be an amazing deal, smoking hot. But the issue is that the assumptions are wrong. So the 6290 for the year of net income, let's take out all the other expenses that I think are very, very likely to happen. All right. So the vacancy is at $900 or 10%. All right. So take that from the 6290. Let's say you had to turn a unit because somebody moved out over the course of the year. Call it 2,000. Pest control, because you want to make sure that there's no bugs in the property or there's no termites, no roaches, none of that. Let's say the person that you kicked out, you had to evict them. So let's call that $120. Most people don't do this when they're doing single family because the banks don't require it. But I think you probably should save a little bit of money for capital improvements. The roof's going to go out eventually. You're going to have to replace the AC at some point. Maybe you need to update countertops, replace flooring, whatever it is. You need to save some of your income in order to be able to fund those capital projects, because you're not going to be able to get it out of the $500 a month of income that this thing is throwing off in the other scenario that was framed for us. And then finally, let's call the mortgage $3,000 for the year. So I don't know if anybody's bold enough, but can you tell me what the net income is for this property based on those new numbers being added in to the overall expense? Anybody? Somebody, please.
Negative.
How much?
3, 4, 5, 6, 7.
She's doing it in his hand. That's
7,500 minus 6,290.
That's like $1,300, right?
Yeah.
$1,200. So, this deal just went from you making money every month to you losing $1,200 over the course of the year. And this is your retirement plan. Now multiply it by 10, because you got 10 of these doing the exact same thing. I just don't think it's the right answer. So let's use me as a case study, right? Let's talk about who owns multifamily investing. So I talked about some deals being hundreds of thousands and others being millions. So most of the folks who are independent operators, some folks call them mom and pop, they're buying deals that are something less than $10 million. And they're doing these deals with friends and family. Usually it could just be family, could be friends who partner up and they just want to buy deals through joint venture. They're not taking money from outside folks that aren't actually active in the deal, and they're going out and they're making a living. There's syndication groups, and these folks are usually trying to buy something that's 10 million to, let's call it, I don't know, 30 or 40 million dollars. They get bigger because folks are trying to grow scale, but let's call it 10 to 25, maybe 30 million or something like that. And then there's the institutional investors who are taking down really large assets. Let's just call it greater than, 40 million. So each one of these folks has a different target, right? I think for the majority of us here, based on what I've seen, we're doing independent operations or we're doing syndication groups. And so we're playing somewhere between $0 and $40 million. It seems like there's a really wide gap, but the fundamentals are the same throughout the whole thing. So let's go through how I got started. Use this as a case study. I'm gonna walk you through all these, the knowledge, deal flow, experience, and capital. So how did I overcome the knowledge gap? Podcasts, books, YouTube, and my RIA, the Real Estate Investor Association. But my RIA never talked about multifamily. And all this stuff was pre-COVID, so I wasn't able to hop on with people from all over the country on amazing meetups like this one so that we could talk about the thing that I was specifically interested in. But what happened, because I was consuming about 8 hours of content every day, was that I ended up feeling confused, overwhelmed, overconfident at times. And then when I realized that I was actually overconfident, I was frustrated. Because what happens when you collect that information the way that I did is there were gaps, right? Because it wasn't a cohesive strategy or plan to get all of these things in a way that it was consumable and, lack of a better way to say it, makes sense. So after I got whatever knowledge that I thought, one of the people said, hey, you need to create deal flow. And so I went to LoopNet. I got my deal off LoopNet, and I went and took it to the bank, and that's when they all told me no. I should have known a little bit more, but at that point I hadn't heard that LoopNet was a place where deals go to die. And so as I started getting into other deals, I started doing direct mail so I could get in touch with owners of the properties. And then I spent time networking, and those two options proved to be better alternatives to what I was seeing on LoopNet. Now, somebody may be saying, hey, Jerome, why didn't you talk to brokers? I had a broker in on our first deal, and it was on the buy side. And we ended up writing a guy a check for $30,000, but I really didn't understand why we gave him money, because he wasn't actually a strategic advisor for us. We didn't actually get like a pro forma or anything that made us feel super comfortable about buying the deal. And so it's like, why would I spend money on a buy side broker when I could do just about everything else that I felt like they were doing? And so if there's buy side brokers that are creating tremendous value for folks, then amazing. I'd love to spend some time with you. I invite you to my podcast so we can talk about the value of a buy side broker. But, for me, I'd rather keep that money in the deal or split it with the owner so that I can get a better buy price. Getting access to capital. So, there's getting the debt from the bank, but then how are you going to fund your equity portion of it? Right. And so I had some savings outside of my 401k. If you're going to actually operate the deal and you've got a self-directed IRA, you can't actually spend that retirement dollars on that asset. So you got to be really careful about where you're putting your savings if you want to be an active real estate investor. I had some credit lines that I could pull money from. Whole life policy has some cash value. So that was the next thing. And then, the banks were asking for W-2s and other things. So I was able to use that from my last year working. And then the rest of the cash on our first few deals came from friends and family. And, the majority of my friends that are in those deals I've known for over 10 or 15 years. It wasn't like I just met somebody at a meetup or a conference and I said, oh, we're going to go and buy a multi-million-dollar asset together, even though we don't really know each other. I think that's a big mistake that a lot of folks are making. So this was the piece that had me kind of in a lurch for 6 or 8 months or so. And I was finding experienced partners. So the bank wanted to make sure that we could personally guarantee the loan, which meant that we had to have net worth equal to the loan amount. And then we needed some liquidity post-closing that was in excess of 10% of that loan. And at the point, I couldn't actually do that, right? And so the bank denied me 10 times. They told me that my corporate experience didn't matter. I went to hard money because I thought maybe I can get the deal done that way. They told me I didn't actually have a deal, right? There wasn't enough meat on the bone. And, oh, by the way, you don't have experience. So why would we give you our money? The private money lenders, I didn't know of any, right? I didn't even know what a self-directed IRA was or why people would send their retirement dollars to something other than the stock market at that juncture. Now that I've been around a while, I've seen how those things work really well. And so that's another option and why the syndication route has become so popular, in my opinion. And I'll be honest with you guys. So when I decided that I actually wanted to own multifamily, I was a sophomore in college. Me and my buddy Duran were sitting on the stoop. I was paying $395. I had 2 roommates doing the same thing. Duran was downstairs. He had the same thing happening in his unit. Well, when we multiplied it around the complex, guy was making $700,000 a year. We never saw him. We never talked to him. I didn't need $700,000. I would have been fine with 70. especially if I didn't have to go talk to people to get that money. And so this issue was the same as when I left corporate America. I still didn't know anybody to tell me how to do it or how I could do it. And they certainly weren't willing to partner with me. So what you're doing here, networking, coming and getting that education, I think is a great opportunity for you to move further down this path. So that's what I should have done, right? I should have went to conferences. I should have taken a course, because when you're in a course with people who are on the same mission as you, you know that they're serious because they invested capital in order to get some education. And, with that, you also are speaking the same language and using the same framework to evaluate deals. So that just really embeds or jerry rigs your success. And the last thing that I should have done that I didn't do was join social media groups. I think there would have been a tremendous value for me there. All right. So my most costly mistake was being self-taught and inefficient. It was the most inefficient and ineffective way to get this thing done, right? There were 40 hours of content. I talked about 8 hours a day. And, I took some time off on the weekends, right? Because it wasn't my full-time job. I made modeling mistakes. I remember that unit, that asset that my parents were standing in front of, I modeled the taxes at $1,000 instead of $10,000. And you talk about the net operating income thing and how much that dropped the value of the property because I made that mistake because it's an expense. It was just one of those things where it's like, man, you can't make up for this mistake that you made. I've underestimated rehab budgets. I put rose-colored glasses on or ignored signs of real problems for the sake of closing the deal. And it's cost tens of thousands, if not hundreds of thousands of dollars that we didn't expect. And probably the worst thing that I've ever done is not properly vet my property manager, count on them to actually deliver an outcome for me that they had no capacity to deliver on. But, I was there, they came through the RIA, and I thought, man, this would be great. But it didn't actually work out that way. So as we wind down, I just wanted to summarize the 10 reasons I think we should leave single family rentals behind, right? Scattered site properties can be intense. The valuation model for single family homes is very vulnerable to what's happening in the market around it. You're not really paying down the principal. Vendor pricing varies pretty dramatically depending on what part of town you're in and what vendor shows up on that given time. Scaling is extremely challenging. There's more granularity on vacancy. The price per door to rent ratio is out of whack from my perspective. A lot of people over leverage. There's no power of the cap rate when you're dealing with single family. And the competitors are there, right? You've got a ton of competitors on the single family side, where when you do multifamily, you have fewer competitors. So I want to offer you all some free resources, right? We've got our podcast, Multifamily Missteps, and I bring on operators from around the country to tell their war stories so that you can avoid making the same mistakes. I don't actually think we're in competition. I think that we are on the same path, same page and the better that you operate, it makes things better for me because we'll all be able to raise our rents and operate our properties at a lower expense. So that's available on YouTube and all podcasting platforms. And then if you want, you can jump over to myersmethods.com and get our free 4-step guide into getting into multifamily, right? It allows you to see the things that you can bring to the deal in case you feel like you don't have a whole lot to bring to the table, among a bunch of other things. And there's also a 15-minute podcast that you can only get by going there that talks about why we like joint ventures over syndication. And the last thing I wanted to tell you about, I told you I would talk about a little bit, is the Mid-Atlantic Multifamily Investing Conference. It is happening September 17th through the 19th. We're going to start at 6 p.m. on a Friday, Eastern Standard Time, and go till about 1 o'clock on Sunday. And you're going to hear from speakers from all over the globe. We're going to have some international speakers this time, and they're going to tell you about their story. Nobody's going to come in and beat their chest and talk about how many doors they have. They're going to give you all of the goodies so that you can come in and be extremely successful with your multifamily investing career and place your capital in the right assets, ones that are going to generate a return for you. And so that is the end of my prepared content. And I see I have one question here, and so I'll go ahead and address that. And it's, how does direct mail work in this case? So direct mail is, we use a letter, and we go and collect information from the county GIS for all properties that are zone multifamily. And then if the data is rich enough, we'll filter out based on size. And once we find the properties that fit into our buy box, we reach out to the owners and see if they would have any interest in selling their property. And if they would, then we'd love to spend some time talking to them, getting to know more about them and their financials. If they don't, then we'll check in with them later, but at least we know we have a good address for the owner of the property. So hopefully that makes sense. If not, then give me another question and we can rock on.
Yeah, Jerome, thank you so much. This was great. I have a quick question. So for some of the people in the audience, what are the Myers methods?
So, what was the last part?
Yeah, what are the Myers methods?
Oh, so the Myers methods is just our 4-step process of buying multifamily properties. And so it's find, fund, fix, and flip. So you got to find the deals. Once you find them, you got to figure out how to get them funded. And that includes everything from putting your team together, putting the operational team together. So there's an ownership team, there's an operational team, going through your physical due diligence and all those steps. That's followed by fix, which is executing that business plan, growing the property, growing the net operating income. And then we finish up by flipping it. And flipping it can be as simple as refinancing the property and harvesting the initial investment in the property.
Makes sense. So yeah, we have another question. So what quantity of direct mail are you sending out?
Yeah, we usually drop about 250 pieces each time we go through.
Okay. And yeah, and next question. So how do you think about valuation on multifamily, given the compression in cap rates? Seems like you're chasing momentum or crowd markets, or assuming prices in depressed markets will recover. How do you account for these factors into your IRR valuation or valuation?
Yeah, JK, I don't remember saying anything about chasing depressed markets or trying to anticipate what's going to happen in the future. I don't do that. I buy in the town that I live in because I think if you understand the real estate market that you're investing in, you can make money. And we just want to buy quality real estate. So there are people who think they can look into a crystal ball and figure out what's happening based on economic factors, but that's not part of our model.
Yeah, I mean, I think part of the answer could be, first, cap rates are not so compressed and interest rates are really low. So it's a pretty big spread over there right now. It's actually, I think, at a relatively high historic level. So I think that's part of the answer to that. I hear a lot of narrative on compression, and that's correct, but that's in part because interest rates have gone down.
Yeah, I mean, the cap rates are working at the numbers that they're working at because interest rates are so low. Mm-hmm. Once interest rates rise, then the cap rates are going to have to rise. But I can't control any of that. That's not part of our model.
And actually, a related question I wanted to ask you during your talk, because you mentioned like there's here this discussion where, okay, when you do multifamily versus single family, you have a lot more control as if over the valuation. That is, so you have more control over the value add. That's correct. Generally, in residential, you need to do like some super creative, conversions and stuff like that, maybe to realize that. Now, so that's correct. But in a market sense, maybe not fully, because even though in residential, okay, you have comparables that, your neighbor sells their property at a given price, and that affects you, right? Like to your point. But there is in super large multifamily, it would be, okay, your neighboring building sells their property at a undesirably high cap rate. So that's still there, the comparable is there. The comparable is baked into the market cap, right? In that sense. But but you're completely right that it's an extremely big control that you have over your own property, where you can, yourself drive your forced appreciation and value add and just raise the property value by, $1 million or whatever. So that is sort of a buffer and protection for you that it's really hard to do the same in residential. And typically it involves extensive renovations. And in large multifamily, you could often do it with, even in theory, lacking renovations. You could in theory do it by simply bumping up the rents if if they were to be below market. So, yeah, but just like a nuance, like I wanted to add that is in terms of the market side risk, or sort of this kind of comparables risk, to an extent, it's still there. It's just there not through the price, it's there through the market cap.
So I would argue that the risk is in rental rates more so than cap rates, because cap rates will go back as much as 3 years on the trades. And the other piece of that is I've bought stuff and we've gone as much as 30 miles in order to find a comparable property. So just because something's sold down the street doesn't mean that it's actually comparable, right? It's got to be same vintage, same style. And like what we like is gardens, or we like townhome communities. And so if there isn't a townhome community that sells at a high cap rate, then you're not as vulnerable. And I guess the last thing I would say on that is we really have to be careful with the fact that these things only trade so frequently. You're going to see, you can see a single family home trade multiple times within 5 years. It's highly unlikely that your multifamily property is going to trade that frequently. And so the amount of opportunities for things to go wrong or bad is greatly reduced there. And, even if I expand that, this is a really good question. When that property trades, if it trades because somebody's under duress, the cap rate's going to be even lower. It's not going to be high because their business isn't operating well. They're selling it because they're not making money.
Sure. I mean, in the sense of, in that sense, that could be, yeah, absolutely. I mean, sure. I mean, dependent on how, unless it's an actually decent, unless it's not a depressed NOI and it's normal NOI, in which case if they're selling at a high price. But you're correct. And actually you made a really great point about the history of the kind of cap rate comparables being 3 years and all that. That's a big difference actually.
Yeah, because neighborhoods you're doing 6 months.
Yeah, I mean, your single family, like the single family discussion of essentially having like having a lot of your revenue wiped out in a, like really easily, and like the whole volatility of your, it's enormous. That's a huge, like the risk adjusted returns in multifamily are higher. Yeah, it's absolutely. And we have another question. So inflation, how do you think about the inflation risk, higher rates on your exit valuations?
Yeah, I think you have to have some cap rate expansion. Can I tell you what's going to happen in the next 5 years? I can't. But I think you should have something in there. The thing that I really work hard to control is what the net operating income is. The thing with inflation is that your rental rates are going to go up. And so your income is probably going to be higher than what you expect it to be if there's inflation. And you combine that with maybe those expenses go up, but they probably don't go up at the same rate. So it's highly likely that if there's inflation, your net operating income is going to be higher than it is.
Mm-hmm. Yeah. So Angel is commenting with inflation. You want to be in those hard assets too. Yep. So do you guys have other questions? Because I think Jerome needs to jump into another meeting soon, right? Jerome, thank you for taking all the time, actually. That's been really great. If you guys want to give like last couple of questions, maybe. Okay. Well, I'm going to squeeze in another one myself now. So another thing in large multifamily, so that I kind of have a kind of conceptual disagreement with, if you will. So in large multifamily, if you say like it's economies of scale. So economies of scale, so you have like a big asset, you're realizing economies of scale. Okay, and then on the other hand is claimed the benefit of the asset being priced on its NOI, which is indeed a benefit because you have levers to changing that and raising the value of your property. But at the same time, simultaneously being priced on its income essentially makes your economies of scale sort of priced in. So you could have them go both ways. You could have economies of scale, or you could have the opposite, where you can have a fourplex trade at a lower price per unit, just because that large multifamily is priced at a cap rate where, okay, all those conceptual economies of scale are actually priced in, and now it's suddenly super expensive because they are selling it at a 6 cap or whatever cap. And, just a consideration that there is a lot of like the definitely, like super logical benefits of having more units, and not even discussing the risk side, that the risk side is kind of a no-brainer, right? It's like definitely so much less risk, and you made a great discussion of that and a great illustration, by the way. But just as a comment that some of that is priced in. So some of that is actually priced in already, so into your cap.
Yeah, but is all of it priced in?
No, well, it depends. It could be priced in a sense that it's actually a higher price per unit than comparable residential properties in the area in theory. It's more seen, this kind of nuance, I would say, is not seen versus single family. It's more seen if you look at the peak of a residential property, which would be a fourplex, that is sort of realizing a little bit of economies of scale, and nevertheless is not priced at all according to the income method at all. So it's kind of that realizes some, like some potential, just a conceptual, kind of conceptual comment, because it's sometimes people assume, okay, if you have 100 unit, that's more economies of scale than a 50 unit, or more economies of scale than even a
service call costs what a service call costs.
Yeah, exactly. But
the thing that you do get in that is, are you calling somebody or is your maintenance person taking care of it? You can afford to have a full-time maintenance person, and they cost you X over the course of a year versus having to call an outside vendor because you have that person. And so that in and of itself is a cost savings, but there's other things. Like if you're doing a renovation project and you're buying for flooring for 100 units, that pricing is going to be very different than if I go into Home Depot and buy flooring for my single family home. And so that's what people are looking at, the things that are actually at scale.
Yeah,
right? Because most of that stuff doesn't actually
I agree.
matter.
And the repairs in the small space, they completely wipe you out, like often, like you said, and people are actually losing money and they don't know they're losing money.
1000%.
It's incredibly challenging to do. And yeah, absolutely. And just, before we wrap up, another question on the chat. So how do you compare the return profile of owning public multifamily equities, like REITs, versus owning a deal yourself? Meaning how much of a spread on cap rate are you looking for as a premium on private deal to offset the liquidity risk you're taking? Okay, it's illiquid. So it's private equity versus, public illiquidity.
I'm not looking for liquidity. You don't buy real estate for liquidity, right? You buy Bitcoin or you buy a current, something that is going to trade and has a lot of volatility. I'm buying a business, I'm improving its operations, and through that, I'm going to grow the net operating income so that I can harvest that equity. It's predictable, it's pretty safe, and I'm more interested in my asset being hard, because when inflation happens, you having your debt locked in at something less than 5% is a whole lot more important than being able to pull your cash out, because you can't put your cash anywhere else. And the inflation is going to eat you alive. Whereas the value of that asset is going to go up because I can change my rent on a monthly basis to capture what's happening in the marketplace. That's adjustable for me. And so that's the game that I'm playing. And I'm active. Back to the business owner versus the investor quadrants. I'm active. I'm getting the equity from sweat in addition to the cash that I've invested. I'm not just trying to get investor returns?
I guess maybe it's to reverse the question or like change it. Maybe it's kind of like how much more than the stock market are you trying to target?
We look to double money in 5 years. We want to have a cash on cash return of 15% on an annual basis. Now, if it's less in the beginning versus going up, then I'm okay with that. But the big hit is on the exit.
Yeah, I think that's a great answer. And yeah, you guys have also pretty big cash component sounds like there as well. So yeah, so which geographical markets you're invested in? And we're going to
Greensboro.
Jerome. Thank you.
Yeah.
Greensboro. Okay, you answered there. Okay.
Yeah.
So
I just want to adjust JK, right? So JK, I'm not an economist, right? And so I feel like you're arguing economic concepts that don't actually, from my perspective, matter, because at the lowest level, I'm running a subscription-based business. People need housing. It can't be outsourced. My goal here is to make investment, buy stuff at a great price, increase the net operating income through either increasing income or decreasing expenses, and then follow the market that way. If you look at the great real estate depression, recession, whatever you want to call it, you will see that the folks who bought multifamily didn't go into a bunch of default because people still needed a place to live. And so that's the game that I'm playing. Do I think I could get bigger returns in Bitcoin or some other equity? I could. Can I sell it today and pull it out? I can, but I'm playing a longer game. I'm making investments for somewhere between 3 and 10 years with the concept that I'm going to be able to make the net operating income in whatever exit year it is, significantly greater than when I buy the property. And if I do that, I make money. If I don't, then I lose. And that for me makes it very easy. I don't have to worry about what happened with whatever that company was that, the people did the Reddit feed and they ran the price all the way up and then they slammed them and it came back down. Like I don't want to play those games. Like I get to set the rent for our property. We get to collect it.
Yep. Yeah.
So that's what I want to do.
You're doing private equity basically is what you're saying. You're
doing
private equity, private deals. In theory, you could be market neutral. In theory, you could, you could be arbitraging the markets as well. Now, it's hard to do. One would probably be subject to, market forces. But I kind of agree with you on the economic.
It's just I'm not that smart. I know people who study economics. I'm not buying huge deals for that reason, right? I'm buying smaller deals because in solid marketplaces. The market that I live in has led the country, top 5 or 10 in the country in rent growth for the past 5 years. Is that going to continue? I don't know, but I know we're still trending behind the national average. And so I think we can chase the average. But, with that said, I got to run because I'm being really rude to the next group. But thank you so much for the opportunity. Angel, you've been rocking with me. Thank you so much for diving in and giving me the backup. I certainly need all the help I can get. And if I can help anybody, please let me know. Connect with me on LinkedIn. Talk to you guys soon.
Thank you, Jerome, for taking the time. That was great. Thanks, everyone, for joining.